obviously there's been a fair amount that's ended up happening in crop markets over the last couple of months. So I'm going to talk a little bit about some of the things that are going on in terms of price action, some things that we're potentially looking at as we move forward, and then also talk a little bit about the importance of identifying where revenue streams are coming from for this year's crops. We all know about some of the drought that we ended up having over the last couple of months. We've seen some relief there, but for a lot of crops, the damage is already going to have been done, and this latest rain is not necessarily gonna help. So one of the big things is just knowing where our revenue streams are coming from and how do we incorporate that into our marketing decisions moving forward. And so when we look at kind of trading ranges, this has been a crazy marketing year when we look at the production season. So when we look at some of our futures contract prices, what you'll see is some enormous ranges, and this is just from March until present. And so when we look at a trading range of 82.5 cents to 133 cents for the December cotton contract, 562 to 766 for the December corn contract, and then November soybeans from 12.89 to 15.84. When we look out to July 2023 wheat, it's 791 to 11.58. So again, we've seen tremendous daily volatility as well, which can make it challenging when we're considering making marketing decisions. Because when we see that volatility, it's one of those ones where it's like, should I make the decision now or should I wait? And that can be both on the upside and on the downside when we're looking at it. If you see a 45-cent move in beans one day to the upside, you might sit there and say, well, maybe it'll go up another 20 the next day. And it gives you kind of a paralysis in the marketing decisions, making it difficult to act. In addition to that, we're under compounding circumstances. So what is my true production going to be this year? Corn's obviously been hit very hard. We'll go through some of the latest numbers in terms of what production estimates and yields are looking like for the state. But when we look at the current corn chart, this is the December contract. What we've seen is we've come off the low of 562 and now we're back above $6. One thing that I would encourage people to consider as they end up looking at marketing their crop is obviously we're going to be down in terms of production. I'll show the acreage and the yield estimates for Tennessee, but I would consider what does that do for my local corn supply and demand, and what do we look at in terms of basis? When we look at the futures market, we're seeing international and national influences. When we look at basis, we have to factor in what's going on in our local communities to make decisions. Soybeans, we bounced off lows as well. I think we've set the harvest low. I don't think we'll get back up to the high before the harvest contracts come off the board. But what we can see is kind of moving between that 1360 to 1480 range in soybeans on the futures crop. So thinking about moving forward on some of those, that's a pretty reasonable range to anticipate soybeans to continue to trade in. When we look at cotton has exploded to the upside. It's one of those ones where there were some really bullish numbers that came out in the latest USDA reports, and a lot of it is to do with the abandonment number, which we'll talk a little bit about. But right now, cotton with that strong uptrend, I think there's more movement to go up, and we can't rule out a challenge of that high of 133 because of the supply and demand factors that are at work there. When we look at these gaps, we had back-to-back limit up trading days as a result of that USDA report. When we look at wheat, obviously we're a long ways out, but people are going to start making planting the wheat crop in this fall. So when we look at where we're trading, a reasonable range is that 790 to 877. And so again, thinking about where that price is relative to do we want to get a floor price under our wheat production or look at maybe pricing a little bit at that level? You can see we've reestablished at a higher level than where we were even before the big run up as a result of Russia-Ukraine. So just thinking in those terms, where are we comfortable pricing and can we protect that downside? So when we talk about that August WASDE report, it was actually a pretty substantial report in terms of market action. There was a little bit of surprises in there. National yields, 175 bushels per acre for corn, 52 bushels per acre for soybeans, 837 pounds per acre for cotton, and then national all wheat average of 48 pounds. Acreage was pretty close to where it was estimated before, so I'm not going to go through all those numbers. We'll circulate these later. What I really want to kind of focus on, and you have to recognize that under these current circumstances, there's likely to be continued revisions to these numbers. But the Tennessee corn yield was estimated at 130 bushels per acre. And just to kind of put that in context, it's about 45 bushels lower than what our trend line yield is. So we're talking about substantial reductions in what is being projected. Now, will we see revisions to that? We probably will see some. But again, our production is going to be well off of where we would normally end up being. Soybeans at 44 and then cotton at 869. And when we look at our harvest acres actually pulled back a little bit on corn at 920,000 acres, whereas last year we were at 970. So again, when we factor in that yield expectation plus harvested acreage, what it shows is a constriction of supply within the state. And so we all know that we're a corn deficit state in terms of what we use exceeds what we produce. So the question is, what opportunities are going to be available through basis in addition to anything that happens in the futures market? And then when we look at our other commodities, 1.77 million acres of soybeans and 315,000 acres of cotton. I'm not going to talk a lot about the drought, but it is important when we think about the potential implications. Obviously, we had several of our drought areas over the last 3 weeks have gotten, 6+ inches of rain. What that does for crops moving forward, it's going to be too late for the majority of the corn in West Tennessee. Soybeans, it's going to depend on when they were planted. Cotton, we might see some benefit from some of this moisture and helping improve the crop, but across the board, we're likely to be well off where we were anticipating in terms of trend line yields for all of our crops. So when we think about kind of the process that we work through when we have a change in production and market conditions, what we want to do is go back and kind of revisit where we are on a field by field, or specifically an insured unit basis, just to see where our revenue streams are coming from and how can we incorporate that into future decision making. So the first thing that I always suggest is to take a look at where your cost of production is. There's a really good chance that your pre-planting budget is nowhere close to what actually ended up occurring, whether it was increase in prices or maybe there was different applications of either fertilizer or chemical that didn't go out. So having an understanding where our investment in the crop is by insured unit is imperative, just so we can have an understanding of, okay, where are we at based on what we've got invested and what our potential revenue sources are. The next one is to look field by field. I've traveled all across the state this summer, and the big thing that I've noticed is there's tremendous variability. And I'll speak mostly about corn, because I think that's obviously the one that's been the hardest hit. But there's anything from complete write-offs to some corn that actually looks not bad. As you go east to west, the corn definitely ends up getting worse, but you do get a high degree of variability even at the county level. If you're able to catch a rain, is something where some fields actually, might be in that 150, 170 range, whereas, fields just up the road are going to be almost complete write-off. So having an idea of what each field is going to end up yielding will allow you to end up at least formulating some expectations in terms of what you've got marketed and what you might have to remaining to market. The next big one is obviously having a continual dialogue with your crop insurance agent. It's something where it's essential to have that open communication for any major decisions are made. You don't want to void any provisions of your crop insurance policy where you might end up being able to get an indemnity payment. And then knowing what that revenue or yield guarantee is for each insured unit will give you an idea to be able to compare where you're at relative to where you or what your production is, and see if you are going to trigger any indemnity payments, because we want to factor that into our revenue expectations as we move through the year. The other one that's yet to be determined is that harvest price. And with this rally, we have to remember, if we're under revenue protection policies, we get our projected price that's established in the spring, but we get another draw of the dice in the fall when we go through the harvest price determination period. So again, if we rally up a little bit more, that is going to increase what our guarantee is, and then also what the market price is. So we have to factor that into our expectations, and use this base level of protection as a component when we're making marketing decisions moving forward. Then the other one too that can be challenging is how much production is currently priced. If we were uber aggressive before planting or during the early part of the growing season, we need to know if we're going to have enough production to end up covering what our existing pre-sales are, whether they were forward contracted or hedged. Options give you a little bit more flexibility in terms of delivery, but we want to know what we need to deliver and what the quality is going to end up being. One of the concerns that's out there is alpha toxin levels in corn. We'll have to see what ends up happening there, but that can be a real challenge from a marketing component too, because those forward contracts will have quality specifications, and if the quality specifications aren't met, then all of a sudden that corn is no longer available to end up fulfilling that forward contract. The other one that's important to note is there is quality adjustment factors in crop insurance provisions. So again, we want to make sure that we're having that conversation with our crop insurance agent and making sure that we're aware of what the options are if we do see elevated levels of alpha toxin. I think the current standard is 20 parts per billion. If it's below that, it's okay. If it's above that, then we have to look at what some of the options are. And does this forward price production exceed the projected production? So if all of a sudden we have more price than what we're going to have available, hopefully there's a higher price on that forward contract so we can maybe roll that or exit it without too much of a financial penalty. If those price contracts are underwater, we need to have conversations on how to exit those or get those fulfilled. So ultimately what we're trying to get at with this graph is we need to have an understanding, and the way to read this graph is we have our projected yield across the bottom, and then we have our gross revenue along the vertical axis. And what it allows us to do is for any projected yield that we're seeing for an insured unit, if we have 53.6 bushels per acre priced, what does that do for our revenue? And you can see that denoted in the gray bars. And so obviously if you have more price than you're producing, you're going to be underwater on some of these. And then we look at where's our crop insurance guarantee, and then how much do we have left to sell relative to where we are anticipating production. And so just kind of stepping through it in terms of, okay, this is what I'm estimating for production. Here's how much I have priced at this certain level. And then here's how much I have left to sell. Here's where I'm going to end up obtaining potential revenue from crop insurance indemnity by insured unit. I think it's a very important step to take before we get into the harvest season to see what we're going to end up having left after we've ended up looked at where all our positions are in terms of revenue. And just to kind of articulate this, we want to really kind of lay this out in a very simple spreadsheet where we're looking at how many acres do we have, what's our current harvest futures price, what's our expected basis. I put in a very conservative 35. Obviously, I've heard substantially higher basis claims than that, some in north of $2. So we want to factor in our local conditions on it. What is your projected yield? How much do you have in cost of production? And then what's that crop insurance expected actual revenue, where you factor in the harvest price plus your APH yield. So having your crop insurance details by insured unit, I think, is really important. And then if you did do any pre-sales, I just put in 3 different intervals of pre-sales and what that price is to get a weighted average price, see what you do have in terms of prices that have been committed to for delivery, and then trying to get an estimate based on, okay, here's our estimated production. We have 15,000 bushels price, so we have 13,000 that we can potentially look at securing a price at either during the harvest interval or in storage, and then carrying that into the future for sales down the road. Then looking at, okay, from our revenue standpoint, our estimated indemnity payment, if we're going to get one, how much is that going to be? How much is embedded in our pre-harvest sales? And then what do we have left to sell at the current market interval? And where does that compare to what we've got invested into the crop, including what we need in order to bring the crop to market? And so just kind of systematically stepping through it to make sure we know where we're at from a financial standpoint under the current market conditions and where we see things going moving forward. In terms of other considerations, we did talk about this in some of Tori's videos where we talked about, okay, well, what's the options if we aren't going to bring the crop to harvest? Are there other options? I think quality and quality concerns and the potential for dockage is going to be a major issue. So we want to end up looking at what our options are there. And are there strategies that we can end up still maintaining some flexibility, but protecting the price? And then also looking at storage and basis. And I will close with kind of some of the storage and basis numbers that we've seen. But what I did want to do is just point out, this is Northwest Tennessee. These are elevated and barge points. So again, we have to always be careful with what we're showing in terms of basis charts, because it doesn't necessarily factor in poultry, which is one of our strong demand draws in additional to our ethanol facilities. But as you can see, what we've seen is a real spike in our local basis. So again, we want to factor that into our decision. So if you have the ability to store, will we continue to see strong basis as we move through the year? We'll probably still get a bit of a harvest lull, but can we store and make money based on that decision? And so when we look at what historically we've seen in terms of returns to or increases in prices if we're able to store. This shows the harvest low, which is typically in September, and then how much that harvest low on average over the last 10 years has changed based on the month that you sell the crop. So for example, if you wait until April for corn on average in Tennessee, and I've got these broken out by regional or region if people are interested in it, you'll get 71 cents per bushel more if you're able to carry it until April rather than selling right at the harvest low. Now, we do always have to be careful, because when we look at May, June, some of these other months, we might run into labor shortages in terms of moving the crop to market because we are doing other functions on the farm. But as you can see, I think this chart clearly demonstrates that, the ability to store gives us historically a very good opportunity. I would argue that this year we'll probably see a very good opportunity as well, just because of the reduction in state level production. This is the same graph for soybeans, where we carrying it out to May, we get another $1.23. So they're using that storage to take advantage of increases in basis and or increases in the futures price. I think is something that everybody needs to really consider under the current circumstances. But first step is to see where we're at relative to what we've got priced, what we're expecting in terms of production, and what we're expecting in terms of payments from crop insurance.